You put out a note yesterday saying in part, as we see the 10-year nearly hitting that 4% yield, the rise in longer-term yields may not accurately reflect the risk faced in the markets. And you also believe they've just run too far. The 10-year, obviously, and the 30-year hitting multi-year highs. What do you mean by that? Kind of explain that theory, because a lot of people actually are going to the bond market for safety and kind of a place to hide.
Well, I think that's what we're saying, right? Which is that, given where the Fed is on having moved and continuing to move, the bond market is right now saying, well, this is going to continue forever, and we're saying actually some of this is starting to bite, and that you could see rates level off or fall from here as some of this growth comes out of, say, the U.S. economy.
We're definitely already seeing some of that growth come out of the U.S. economy, especially, as you mentioned, the TINA trade's kind of falling apart right now. There clearly is an alternative. Bonds have become those alternatives. Just in general, we have PCE coming up on Friday. I've been asking other people. The Fed doesn't seem like it's going to change its mind about the direction it's going in, but a better than expected inflation report, does that change the mind of the market meaningfully? And how much better does it really have to be?
Well, I think that the Fed is going to have to see several better reports before they even consider pulling back from this rhetoric of hiking and things. Because if they pull back now in the face even of some moderate weakness in some of the data, they're just fighting against themselves. Ultimately, they want to pull that inflation in. They want to see some of an impact before they change in their rhetoric. And so, for us, I think being positioned more on the defensive side in equities, more towards the consumer staples, more towards healthcare, that's the direction we've been going, because, as we set up for the next earnings season, we do think that analyst estimates remain too high and end of the year targets are too high. So be more defensive on the equity side.
Well, as you know, in Wall Street, a lot of people say you buy on the rumor and you sell on the news. Is there any chance that better than expected inflation report, just at least one, might just at least start the thinking that the Fed might turn more dovish in the future?
Well, we've seen that. You're absolutely right. One good data point, and we get these sharp bear market rallies. And that in part says to us that there is still a lot of liquidity sloshing around out there, and some of that's going to have to probably get sopped up before this is really over. So what that means is that the volatility is absolutely going to continue, and there's still people who are going to chase it. But I think that for many investors, looking through that a little bit and focusing on the companies that can do well in a high inflationary environment, that have pricing power, is probably a better strategy than trying to hit every one of these volatile bounces.
So obviously the Fed has its own data points it looks at, like PCE. But one question for you, why isn't the Fed listening to FedEx? You saw the CEO of FedEx come out and say, hey, things are really slowing down. And we've seen that in the supply chain. One of the things that's been a contributing factor to inflation, the supply chain has certainly lowered when it comes to prices and volume. So why isn't the Fed responding to that at all?
Well, and just to add to that, the futures were actually up this morning until Apple said it has weaker demand for the iPhone, and then they turned around as well. It's too early for the Fed to respond to that, because that the wage pressure remains, and that employment is so strong. And if you think about, for the U.S. to have a recession and really see that this slower growth is helping to pull down inflation, it's very difficult given what we're seeing on the labor side. So I don't think they're going to relent until they start to see it showing up in the labor market.